Early this year, in 2020, the stock market plunged into a bear market. In fact, the S&P 500 suffered its quickest fall into bear market on record, and it took the S&P 500 just 16 days to close in a bear market. And this was due to the pandemic. The pandemic not only devastated the health of the population and economies around the world, but also the stock market. The pandemic sent the S&P 500 to plunge by 39%. And on 23rd of March, the stock market bottomed. And since then, the S&P 500 has rebounded strongly. The S&P 500 is up about 50% from its March lows. And right now, the S&P 500 is even trading near its all-time high, making it one of the fastest recovery ever. Not only have we experienced the fastest bear market decline, but we are also experiencing one of the fastest recovery ever. Which begs the question now whether the S&P 500 is poised to take off. Now we'll take a quick overview of the price chart of the S&P 500. If you want to have a more in-depth technical analysis of the US stock market, you can check out my playlist over here where I share my technical analysis of the S&P 500, Dow Jones, and the Nasdaq. But in this video, for the purpose of time, I'll be sharing with you a quick overview of the price chart for the S&P 500. This is the price chart for the S&P 500, and if you take a look at the chart, you'll see that the S&P 500 made its high back in February at around 339. But with the pandemic, the S&P 500 plunged by 39% and all the way to March 23rd where the stock market bottomed. And since then, the S&P 500 has rebounded strongly by posting almost a 50% gains since its lows. And if we take a look at where we are currently at in the S&P 500, we are making new highs. In fact, on Tuesday on the 18th of August, the S&P 500 closed above its February highs for the first time since the pandemic. And in this video, I'll be sharing with you the indicators and data present the fundamental case of why the S&P 500 is poised to take off. The first data that we'll take a look at is the monthly unemployment rate. The monthly unemployment rate is a useful indicator to gauge the health of the economy. And monthly unemployment rate in the US has been on a steady decline since March. The unemployment rate fell to 10.2% from its high of 14.7% in April. While unemployment remains high, we have definitely seen an improvement in the unemployment rate in the US, and this points to a recovery underway. The second data that we'll take a look at is the Purchasing Managers Index, or PMI. The PMI measures the prevailing direction of economic trends in manufacturing. A PMI reading of above 50 represents an expansion compared to the previous month. Looking at the chart here, in June and July, the PMI reading was above 50, and manufacturing expanded in the months of June and July. This indicates that manufacturing not only expanded in June compared to May, but also expanded in July compared to June. So the recent readings of the PMI also lends its case to the recovery being underway. Third is the growth of the economy. Generally, the current economy grows in two ways. The first is the expansion of credit, which affects the short-term growth of the economy. And the second is the increase in productivity, which affects the long-term growth of the economy. And right now, we are seeing both the expansion of credit and the increase in productivity taking place. The expansion in credit is mainly down to the Fed's monetary policy, specifically its quantitative easing program. The Fed has pumped in more than $3 trillion into the economy using its quantitative easing program, which will increase the amount of credit in the economy. And we have also seen an increase in productivity in the economy this year. Productivity has increased by close to 8% in the latest quarter of 2020. If we continue to see an expansion and increase in these two factors, the economy will continue to grow, and this growth might have a spillover effect on the stock market. The fourth is the trickle-down effect of the US government's fiscal policy. Back in March 2020, the US government passed a $2 trillion fiscal stimulus package to help Americans and the economy. And in this fiscal package, Americans who are eligible can receive a payment of $1,200. And this is not including the unemployment benefits for people who are affected by the pandemic. While a portion of this stimulus check is used to pay for daily necessities such as groceries and rent, Americans also save a significant portion of this amount. And if we take a look at the personal savings rate in the US during the pandemic months, savings rate has went up all the way to 32.2%. This means that the average American is saving up to 1/3 of their income. And this is important because many Americans are choosing to invest with some of their savings in the stock market. With many Americans staying at home due to the pandemic, there are fewer things that they can spend their money on. And one of the avenues that many Americans are choosing to put their money in is in the stock market. More Americans are choosing to invest some of their savings in the stock market during this period of time. In fact, many brokerage firms are reporting increase in trading activity during this period. Robinhood is one of such firms. The company reported that it added 3 million funded accounts in the first 4 months of the year alone. Robinhood's hypergrowth is not an isolated case. There is an increase in trading volumes across the brokerage industry during this period of time. Current investor sentiment is the fifth fundamental case for why the S&P 500 is poised to take off. In this survey conducted by BCG, a survey on investors conducted last week found out that there are still a significant portion of investors who remain bearish, 46% to be specific. This means that slightly less than half of the investors surveyed remains bearish about the US economy and stock market in spite of the recovery so far. While some might see this survey as bad news, this indicates to me that there is still further potential upside in the recovery in the stock market. And this comes down to supply and demand. If all 100% of investors are bullish about the stock market, what this means is that demand is already at its highest point, and there will not be any further demand. Without further demand, stock price can't continue to rise, which limits the upside potential of the stock market. And that is why even though 46% of investors who are surveyed remain bearish, this survey result gives me the confidence to know that there remains a potential upside to the stock market. So these are the 5 indicators and data to provide the fundamental case of why the S&P 500 is poised to take off from here. If you have learned something from this video, do like this video because it will really help the channel grow and allow me to continue producing more content such as this. And if you are new to the channel, don't forget to subscribe to this channel because each week I release one new video about investing, trading and the stock market. You don't want to miss out on any of these videos. I'll see you in those other videos to your financial success.